Most people understand money only from the consumer side. You work, get paid, spend, save, and borrow. But beneath everyday life is a financial system most people never see. This is how money actually works, what it is, who creates it, why inflation happens, how central banks manage the economy, why debt and credit matter, and why the entire system ultimately depends on trust. What money actually is. Money isn't simply valuable paper. It's valuable because society agrees it works and because it satisfies three functions. 1. Medium of exchange. Allows us trade goods and services without barter. 2. Store of value. Lets people save purchasing power for future use. 3. Unit of account. Provides a standard way to measure prices, wages, debt, and investments. Today, most money is digital, existing in bank accounts and electronic transfers rather than physical cash. Physical cash represents only a very small percentage of total money supply. 2. Who creates money? Modern money is mainly created by central banks, like the Federal Reserve or European Central Bank. They issue currency, manage reserves, and support the financial system. Commercial banks like Morgan Chase or Bank of America, they create most of the money people use. This surprises many people because most assume banks simply store deposits and lend out part of those deposits to other people. But that's not what happens. 3. How banks create money. Banks create money by issuing loans. Example, if Sarah receives a $500,000 mortgage, the bank credits her account with $500,000 digitally. New money, which is $500,000, is created in the economy, while Sarah now owes the bank that amount. If Sarah or other debtors repay their loans, that money is effectively removed from circulation. In simple terms, borrowing creates money. Repayment destroys money. However, banks cannot create unlimited money because they are restricted by regulations, reserves, capital requirements, and borrower risk. 4. Why inflation happens. Inflation is the loss of purchasing power over time. If a hamburger rises from $5 to $10, the dollar buys less than before. Inflation is caused by excess money creation. More money but same number goods cause higher prices. Prices rise when supplies disrupts, like disruptions in energy, supply shortages, transportation, or production. It can also be caused by inflation expectations. Businesses raise prices and workers demand higher wages because they expect future inflation. 5. How central banks control the system. Central banks manage the financial system, primarily through interest rates and liquidity. Lower interest rates encourage borrowing, spending, and investment, but can increase inflation. Higher interest rates slow borrowing and spending, helping reduce inflation. During crises, central banks may also use quantitative easing QE, creating reserves and purchasing assets to stabilize financial markets and support lending. 6. Why debt and credit matter. Most modern money originates from debt, making money and debt deeply connected. Credit allows people and businesses to use future income or productivity today. Without credit, homes would require full cash payment. Businesses would struggle to expand. Startups and education would be far less accessible. Modern economies rely heavily on circulating credit to support growth and innovation, allowing future productivity to be used today. 7. Why countries cannot just print money forever. A common misunderstanding is why can't governments print unlimited money and make everybody rich. Simply put, they can't because money itself is not wealth. Real wealth comes from production, labor, energy, infrastructure, technology, goods, and services. If governments create too much money without increasing production, inflation rises because more money competes for the same resources. Printing money cannot create real economic output, only higher prices. 8. How the entire system ultimately depends on trust. Trust is the foundation of modern money. Modern finance works because people trust that banks are stable, that currency will retain value, that contracts will be honored, and governments and businesses will continue functioning. If trust collapses, bank runs, market panic, and economic instability can follow. That's why governments and central banks intervene aggressively during financial crises. So in summary, this is how money is created. Federal Reserve creates base money. Commercial banks issue loans. Loans create deposits, which is money. People and businesses spend money. Economic activity expands. Loans are repaid, and money is destroyed. That is the full cycle of money. If you enjoyed this video, click the subscribe button so you don't miss our next video.